Hello, everyone. Welcome to the Committee of 100 virtual conference. We're going to spend the next 15 minutes or so on the topic of economy and the financial markets. We are extremely honored today to have three distinguished panelists with us, whom I have considered not only great friends, but also longtime mentors of mine. Over the years, I have benefited greatly from their wisdom and support. And today's session is no different as I continue to learn from some of the best investors of our time. First, I would like to introduce Professor Andrew Lo, who is the Charles E. and Susan T. Harris Professor at MIT Sloan School of Management. Professor Lo is also the director of MIT's Laboratory for Financial Engineering, a principal investigator at MIT's Computer Science and Artificial Intelligence Lab, and an external professor at the Santa Fe Institute. His current research focuses on systematic risk in the financial system, evolutionary approaches, and applying financial engineering to develop new funding models for biomedical innovation. Professor Lo has published extensively in academic journals, and his most recent book is Adaptive Markets: Financial Evolution at the Speed of Thought. He has won numerous awards, such as the Paul Samuelson Award, the UZ Pharma Prize, the Global Association of Risk Professionals Risk Manager of the Year, and awards for teaching excellence from both Wharton and MIT. And he was also once named as one of the 100 most influential people by Times Magazine. He receives a BA in economics from Yale University and an AM and PhD in economics from Harvard University. Now I would like to introduce Mr. Howard Marks, co-chairman of Oaktree Capital Management. Since the formation of Oaktree in 1995, Mr. Marks has been responsible for ensuring the firm's adherence to its core investment philosophy, communicating closely with clients concerning products and strategies, and contributing his experience to big picture decisions relating to investment and corporate direction. Mr. Marks holds a BS degree, a cum laude from the Wharton School of the University of Pennsylvania with a major in finance, and an MBA in accounting and marketing from the Booth School of Business of the University of Chicago, where he received the George Hay Brown Prize. He's a trustee and chairman of the investment committee at the Metropolitan Museum of Art. He's a member of the investment committee of the Royal Drawing School and is a professor of practice at King's Business School, both in London. He serves on the Shanghai International Financial Advisory Council and the advisory board of Duke Kunshan University. He is an emeritus trustee of the University of Pennsylvania, where from 2000 to 2010, he chaired the investment board. Now I would like to introduce Professor Myron Scholes, a Nobel laureate and a financial economist. Professor Scholes is the Frank E. Bach Professor of Finance, Emeritus, at the Stanford University Graduate School of Business since 1996. And since 2014, he has been the Chief Investment Strategist at the Janus Henderson Investors. He is widely known for his seminal work in options pricing, capital market equilibrium, tax policies, and the financial service industry. He is co-originator of the Black-Scholes options pricing model. For his work on a new theory to value derivatives, he, along with Robert Merton, was awarded the Alfred Nobel Memorial Prize in economic science in 1997. Professor Scholes is a member of the Econometric Society and served as president of the American Finance Association in 1990. He was given the Innovator of the Year Award from the Chicago Mercantile Exchange and the Lifetime Achievement Award from the Derivatives Association. He's a member of the American Academy of Arts and Science. He earned a bachelor's degree in economics from McMaster University, an MBA and PhD from the University of Chicago. So today, again, we are really honored to have three distinguished scholars and investors with us. and the topic of today's discussion is economy and the financial markets. So when the lockdown mandate hit the world in early 2020, few of us knew what it meant to our work and personal lives. Now, how long it would last. Now, more than a year into it, we certainly learned how to adapt. But what does the future hold for economic rebound and growth post the pandemic? So I have the first question. I will start with Professor Scholes first. What trends do you see having emerged from the pandemic, and which of these trends are here to stay in a post-pandemic world?
Thank you, Ben. And it's an honor to be on a panel with Andrew and with Howard, great respected friends and colleagues. I think that I have a lot of trends that I wrote down, but I will try to select a few and then we can come back and talk about others as others bring them up. One is, I think we're moving as a result, maybe even prior to the pandemic, to a period of wealth redistribution and away from a period of wealth accumulation. And I think this cycle is going to be here for 20 years or so, for 10 to 20 years, the wealth redistribution cycle. You know, it is around the world the same thing that has happened in Europe and in China, especially in 2014, when President Xi went into the anti-corruption period. So it's really thinking about an idea of thinking about how to redistribute wealth. And as a result of wealth redistribution, it's going to be an important trend going forward and continue for not 1 year or 2 years, but my view, for maybe 10 to 20 years, as we've had a period of growth from the 1970s Thatcher-Reagan period through till a couple of years ago. A second major trend that I see is going to be one of ESG, obviously, you know, energy and society and governance in our world, and that's going to continue afoot and be very important for the next period of time, again, maybe for the next 5 to 10 years. Another area which is going to be important is the results of central banks pushing on a string. And a lot of it is how we can bring the horse to water, but maybe not make it drink. And so the growth of debt is going to be very important in our society and how we handle that. Basically, that is going to be an important trend that I also see going forward. I think that we're going to see another trend, which is a conflict between inflation and deflation, or weak growth in our consumption and investment going forward. So is modern monetary theory or helicopter money going to be the end result of a deflationary period? There's going to be potential changes in the FRB, the charter, the Federal Reserve Bank charter, such that the Treasury might be able to have a checking account and bypass the reserve system. This is really the people's quantitative easing. And as a result of that, it will create lots of inflation, as it did in China post the Second World War under Chiang Kai-shek, when money was used to printing money to pay for consumption in society, and as other countries have experienced the same inflationary periods. We're going to see a shift from capital to labor, increase in average wages, and the reduction of the tails of the distribution. So it's going to mean a tremendous change in the distribution of investment opportunities going forward. I think there's going to be an anti-big tech backlash as a result of this, and questions of who owns data, questions of the evolution of robots, artificial intelligence, blockchain, eroding the power of labor, and how to stop this trend or integrate it with what's happening in the redistribution framework.
Thank you, Professor Scholes. You highlighted a few really critical points, and we'll come back to your comments later in the session. Now I would like to turn the mic over to Professor Marks.
Well, the trends emerging from the pandemic range from the everyday mundane to I would say cosmic. In terms of the everyday, you know, I think we're moving back in the direction of normal. The question is, how far will we go? I've been, I think, on the side of those who think we're going to get more back to normal faster than most people think. But I mean, what I've been saying is that I think that 80% of the people will go 80% of the way back, or 90% of the people will go 90% of the way back, something in that range. But I mean, I think there's going to be a lot of return, but I think there will be some longer lasting effects. Broadly speaking, we're going to be using much more technology coming out of this than we did going in. I mean, the everyday person, things like shopping from home. The trend toward shopping from home will be amplified by the events of the pandemic. Travel, an interesting question. Will we return to travel? Will business travel be the same? I heard somebody say early in the pandemic that the days of getting on a plane and flying halfway across the world for one meeting are over. Well, are they? We'll see. Zoom has worked very well. Clients will still want to see us in person. Working from home, we're going to have a very difficult transition. People have gotten used to working from home, and especially to not commuting. And some of them are going to want to continue to do that. Some employers are not going to want to continue that. So a number of everyday things. Of course, the greatest of all is that we've all had to learn to say you're on mute. Now, as for the cosmic things, I'd like to say that 2020 is the year that the word trillion came into common use. We bought trillions of dollars worth of bonds. We made trillions of dollars of grants and loans, and so forth. And the first relief program was almost 2 trillion, and since then we've had even larger ones. So, and by the way, multi-trillion-dollar deficits, multi-trillion-dollar additions to the national debt. So, it's kind of almost like the dam has broken. It used to be that people would look for pay-fors, what we call them. How are we going to pay for small expenditures and small deficits? And now that they're so enormous, it's kind of like people have thrown in the towel, and nobody's concerned with paying for these things. And the long-term effect of injecting the kinds of liquidity we are, running the deficits we are, adding to the debt as we are, we don't know how this is going to end up, and that's an open question, but it will affect the years ahead.
Thank you, Mr. Marks, Professor Marks, for your comments. Now, Professor Low, please add on your opinion of the pandemic, the impact on the economy and the society and the financial markets.
Being the third to weigh in, I think that they've said a lot of the things that I was going to say. So I certainly agree with the kind of trends that they've identified. If anything, I would say that what I see is a speeding up of the natural evolution along these lines. In particular, the fact that the pandemic has really created a completely different perspective about how we think about life, work, and all of the issues that we were struggling with the technology boom. All of that, I think, is speeded up. So, for example, in the issue of technology and how automation affects our lives, I think the last year has demonstrated that technology plays an absolutely essential role. We wouldn't actually be able to have this conference without the technology that we're using right now. And so I think automation is, as Myron said, going to be a continuing issue in terms of how we think about labor and capital and the redistribution of wealth. I think that we're going to see that coming to a head, but probably not for another 5 to 7 years. In that interim, I think we're going to see some tremendous economic growth in much the same way that the 1918 influenza pandemic that was far more deadly than COVID-19 in terms of the mortality rates at the time, and the fact that we actually weren't able to write about it and engage in active policies to deal with it in this country because it was in the middle of a war and we couldn't publicize it. That pandemic, as difficult as it was for us to get through, actually led to some tremendous economic growth, very much along the lines of what Myron suggested, including wage growth shortly thereafter. And of course, the roaring 20s that emerged out of that 1918 milieu gave rise to some tremendous economic innovation. And ultimately, I think we ended up overdoing it, and it led to the 1929 stock market crash and the Great Depression. I believe that we're sowing the seeds of the next financial crisis. It'll probably take us another 5 to 10 years to get there. But if we're not careful with the stimulus that central banks around the world are engaging in, we may very well be seeing that level of crisis eventually. So that's one of the things that I worry about. But apart from that, I think the same kind of trends that both Howard and Myron have pointed out, I certainly agree with. And in fact, the stock market performance that we've seen over the last year and even beyond it, I think highlights the fact that market participants recognize that there's tremendous economic growth that will be happening, but there will be consequences, so we need to be wary about that.
Thank you, Professor Low. So maybe I can, all of the three of you highlighted or mentioned the role of technology and automation. And this is, you're absolutely right that this is a trend. I call this pre-existing trend even before pandemic. And the pandemic accelerated this trend among a few other trends such as ESG, which we'll talk about later in the session. But on the technology and automation, I'm just curious, what are the potential implications for the society in terms of income inequality, wealth inequality, and the displaced workers by technology and automation? As you mentioned, in the past, we always figure out a way to work around it, and people find a new kind of jobs, but with government help and training, and then the help from the society. I'm just curious from each one of you, your view, as we coming out of the pandemic, as we become more technology enabled and with more automation in the economy, what can be the potential impact on the society? So maybe I'll start with Professor Low.
No, I think that we are going to see some potential problems arising because typically automation focuses on the lowest level of skills that can be most easily automated. And as a result, the unemployment trends that we're seeing over the course of the last few years are going to be affecting those workers that have the most basic levels of skills. For example, once we have driverless cars, then truck drivers are going to have a very difficult time finding work. And whereas the ride-sharing technologies that have been developed by Uber, Lyft, and others have created jobs, we're going to see the exact opposite happening once we are able to have driverless cars. So in the past, the way we've dealt with that kind of obsolescence of older technologies in favor of the new is to basically retrain the labor force. It takes a few years. It is possible to do. The problem becomes when the speed of technological innovation is so rapid that there isn't time to retrain the workforce. That's what I worry about. And I think this is what Myron was getting at with his point about inequality. If it turns out that these technological innovations happen so quickly that there isn't enough time to retrain the workforce that's been displaced, we're going to see a real problem in society. I mean, that's where revolution happens, where you have nothing to lose but your chains. We have to be very, very wary about that and deal with the issues ahead of time so that we can provide people with ways of making a living when we take away their jobs with these technological advances.
Thank you, Professor Low. You brought up a very good point. This time around, the change is the speed of the change. Would we, means the society at large together, collectively, would they have enough time to reposition the labor force for the new economy? So on that note, Professor Scholes.
Andrew is completely right that technology goes at its own speed and it's very hard to stop it, and that we are seeing great increases in technology. And just one point in terms of the blockchain technology and AI,
that we might end up in a situation where not only blue collar workers or lower paid workers are displaced, but basically the middle level workers and accountants all the way up are displaced. And if blockchain comes into its full force, we might get a complete change in the financial service industry and many other industries where basically we bypass the cost of all the intermediation that's occurred over myriad years. And so this is a big threat. And what has happened in terms of what the Biden administration and others are proposing is that we use our labor force in an interim period to build the infrastructure that we think we have lagged in and not built for so many years. So that advent of the infrastructure projects are really for value added, but a stopgap measure to figure out what we do in terms of retraining the labor supply. But the future might be with all this technology, we get the ability to sit in my backyard and read poetry and paint and not have to go to work. And as we're seeing now in the way we tend to be supporting people is having a minimum wage, minimum distribution of wealth so that we have a redistribution to be able to move society forward. With an aging population that we have in the United States, China, and Europe, basically we're having a whole change in what services are going to be needed. So we're going to have a great growth in infrastructure. We're going to have a great growth in how we help and foster the evolution of the aged to a more sustainable existence, from healthcare to support to everything. So there's going to be a lot of changes in the use of robotics. There's going to be a lot of changes in the use of technology so that our labor force is going to change things that it's involved with. And important to what Andrew's saying, I do believe there's going to be a complete change in education. We've learned to do distance learning. We have to think about the young and think about how we educate them going forward, how we make our educational system flexible. And I think there's going to be evolution in that dimension, which it will lead to changes there. But I think the combination of infrastructure, building out infrastructure. Coal is dead. Obviously, coal is dead, through the ESG movement, and even the senator from West Virginia mentioned is saying, as long as we can have the union power, have good jobs for my workers who are going to be displaced from the coal mines and move them to infrastructure. And one of the things we need is that we're going to move CO2 from and sequester it in various places. We're going to need thousands of miles of new pipelines to be able to do that. So labor is going to be moved to new infrastructure projects to marry together the ESG projects we have, the energy sequestration and other energy projects to build new infrastructure. And that's something the government is becoming more involved with. So we're going to see more private-public partnerships in that dimension.
Thanks, Professor Scholes. So the policy responses to the COVID-19 pandemic, both monetary and fiscal policy responses are unprecedented. And at least in the short term, in the near term, it has proven to be quite effective. But all of you mentioned in your opening remarks, for example, Professor Lowe mentioned that, are we sowing the seed for the next crisis because of the unprecedented monetary policy and fiscal policy? And Professor Scholes mentioned, using the analogy, are we for the next crisis, would central banks pushing on the string, given the amount of debt we have now and we continue to accumulate? I guess my next question is, what's your view in terms of these policy responses, and particularly what are the potential long-term implications? And as an investor, what we need to be mindful of? So that I will go to Professor Marks first.
It's a little bit above my pay grade to second guess the Fed and its economists. I think that they had to take dramatic action. I think that the world was heading for a global depression with all the economies of the world stopped. So it's great that they took action. They took it incredibly promptly and in great scale. Clearly, it worked. you can't criticize any of that. You know, there are negative possible ramifications, but I like to point out that just because something has negative possible ramifications doesn't mean you shouldn't do it. Many medicines have possible negative side effects, but we take them anyway because they accomplish something more important. And I think that was true of the medicine that the Fed and the Treasury applied here. So, you know, anybody could say it could have been more focused. It could have been a little smaller. Obviously, you want to get the fraud and waste out, but that's difficult, especially when you're trying to do something in scale in a hurry. So, you know, I would certainly give the Fed and the Treasury an A overall, especially if you mark on a curve. I can't imagine anybody could have done better within the first month of the pandemic. We know that the industries that depended on getting a lot of people together are the most affected: hospitality, travel, cruise ships, movie theaters, sports events, even restaurants, of course. And that the ones that don't rely on getting people together or benefit from not getting people together, Amazon, food delivery, these kinds of things are better off perhaps than they were before the pandemic. So we know these things. The question is, have the ones that are better off been treated too well in terms of stock price? Have the ones that are worse off been treated too poorly? It's never in investing. It's never a matter of what's good and what's bad. The question is the good overpriced because it's so good? Is the bad underpriced because it's so bad? These are the things that investors have to look for, not merely labeling them troubled or successful.
Thank you, Professor Marks. Professor Lowe, please.
Well, you know, first of all, I should point out that it's very hard for any policymaker to figure out what exactly the right amount of stimulus is. We're basically making this up as we go. We have the financial crisis of 2008 as a bit of background to this. But one of the lessons that policymakers claim to have learned from that experience is that they wish they could have gone bigger. And I have to say that I'm not sure I agree with that lesson. I understand why they're saying it, but I'm worried that they actually maybe learned that lesson a little too well, because you know the stimulus that we've implemented and are currently implementing, somewhere between $1 and $3 trillion, depending on how you count. To me, that is a very dangerous approach to take if we don't get the timing just right and take off that stimulus when we no longer need it. That's the real problem. It is very useful, given human nature. It is very easy to be able to get used to this kind of stimulus and to come to depend on it. And if that's the case, what we are going to see, maybe not in 1 or 2 or 3 years, but you know, in 4 or 5, if we continue this path, we will actually see inflation creeping up. And that's going to be a real concern in the longer run. So I think that it's not necessarily baked in. I think there is a chance for us to be able to circumvent that kind of an outcome if we're able to undo some of the stimulus that we have put in place right now. But that requires a certain amount of focus, attention, and willingness to basically turn off the spigot when it's clear that the tub is nearly full. And so that's what I would worry about. And I would hope that policymakers and economists would be sensitive to that issue and to be able to turn off that stimulus before it's too late.
Thank you, Professor Lowe. That's a very good point. After the global financial crisis of 2008 and 2009, back then, we claimed that the global central banks and policymakers rolled out unprecedented policy response at that time. And we didn't fully unwind that policy response, and then COVID-19 hit us. So we just reacted very quickly and massively, and it worked in the short term. So your point is absolutely right that we didn't even unwind our policy response in the global financial crisis 12 years ago. And then we had to enact a much bigger one, much faster. And the inflation, definitely the risk of of a runaway inflation is real. And you're right, it's not fully baked in, depending on our action between now and then. So on that note, Professor Scholes.
Yeah, basically, if you look at the way the statistics have worked, we've seen since 2000, there's been very little growth in the take of GNP or the take of national wealth of our people who are not invested in the stock market or capital. And so, as I said in my introduction to the talk, that what we've seen, though, is great wealth increases by those who have invested in the stock market or in private investments. As a result of that, we're now getting a situation where there's a cry for redistribution, and we are going to see that in part that the Federal Reserve Bank of the United States, other central bankers, the PBOC or the Bank of Japan and Europe have engaged in, as Andrew said, and Howard said, is great increases in quantitative equity and trying to increase the money supply. In Japan, it's failed to achieve very much of anything. We've had 4 recessions after they instituted this policy many years ago, and have had seen very little increase in GDP over this period of time. Now, there's others in economics who say that basically increasing the money supply is equivalent to letting the banks have more reserves. And the reserves that the banks have are high-powered money. And if there are avenues they can employ the reserves to lend to corporations and others to make new investments and grow the economy, then we have this multiplier effect. And it might be that the multiplier leads to inflation, and they have to control inflation. So the problem right now is as money's increased under the Federal Reserve mandate, that the velocity of money has fallen. So initially money increases, maybe velocity doesn't fall as quickly. So you get a little bit of a spurt for a moment or two. But then as velocity falls, because the money sits there and is not lent out, there's very little inflation that follows because there's very little output, there's very little inflation. You have to have it be that corporations and others go to the banks to borrow money to actually invest and create the multiplier effect that we all learn in school. So in the Keynesian economy, where you go to low interest rates, you go to great government activity and support, then it's not the Wixellian economy, but in that economy, what we do is we have to have there be growth opportunities available. So the interesting issue for me is, when does it stop? You know, does it go to the point where the government then is going to do undertake the investments and infrastructure investments and others, and as a result, they go directly to the Federal Reserve Bank and they ask the Congress to change the laws with regard to how the Federal Reserve Bank operates. No longer is it a Federal Reserve Bank. It just gives a checking account to the Treasury, and the checking account writes checks on that, as FDR wanted to do when the Federal Reserve was formed, and they write checks and they spend money. So basically they spend money, the currency, they create the velocity of money because they're spending more and more of it and it's circulating around. So in a reserve economy, you know, they have to issue debt. The debt is then bought by the central bank, and then it sits in reserves that have to be used. So fundamentally, do they go to MMT, which is helicopter money? They go to helicopter money, we will have huge amounts of inflation that are going to follow. And then on to Andrew's point and others is that basically, can they stop it? You know, once you set this in motion, can it stop? And to what extent we are going to finance activities, not through the reserve mechanism, but through actually a printing of money by changing the rules of the Federal Reserve Bank. So I don't know at the current moment whether we're going to have tremendous amounts of inflation or not. It depends on actually what is done with the reserve mechanisms today in society.
Thank you, Professor Scholes. Speaking of stop something, a few days ago, I think there was an article on Wall Street Journal. The title is "What Happens When the Market Only Goes Up?" So it doesn't seem like the market will stop going up anytime soon. So For example, last March, the market early at the beginning of the pandemic, the market lost about 34%, but the market quickly regained to its previous peak in 120, I want to say 126 trading days. In history, normally on average takes more than 3 years to reclaim the previous peak. And not only this time around, not only we quickly reclaim the previous peak, we keep on setting new record highs. This is about market cycle or market psychology, investor psychology, of course, monetary policy and fiscal policy. And speaking of cycles, I know Professor Marks has written extensively on the topic of the cycle. So maybe I'll turn over to Professor Marks first to comment on the current market cycle. How will this cycle end? And what's the market psychology? So Mr. Marks, over to you.
I think that, you can enjoy the profits you've earned so far. However, there's been great appreciation. The flip side of appreciation is things becoming more expensive. When you take appreciation and you turn it over, you get things becoming more expensive. And and the more expensive things are, the more carefully investors have to tread. So it's no time for resting on one's laurels. The point is that thanks to the Fed Treasury actions, including especially the interest rate cut to zero, asset prices are high. Prospective returns are the lowest in history. This poses a great problem for investors who need a certain rate of return. Most pension funds and endowments need something in the area of 6.5% or 7% a year to make the math work. And it's very hard to see how you get that. You can't own any bonds and get that, or many bonds. Even most people think that the bonds with their low yields and the stock market at the high levels where it is together imply that it will be hard to make that. So then people have to chase after so-called alternative investments like private equity and venture capital and distressed debt and things like that. But those are not infinitely scalable niches. And when the large amounts of capital flees from the stock and bond market and tries to get into the alternative markets, it's hard because it drives prices up, and too much money reduces managers' selectivity and agility. So I think that the low return world we're in is a very problematic setting for investors.
Thank you, Professor Marks. And maybe next one, Professor Lowe.
It certainly is a strange phenomenon. I understand, from certainly most people's perspectives, they would imagine that given how dire the circumstances are, markets should be way lower than they are. And I think that I would start with the observation that we are not in a financial crisis. We are first and foremost in a public health crisis. The public health crisis has financial implications, but the fundamental problems with the economy are not based in the financial system this time. That wasn't true in 2008, where there were some significant issues in the financial system, and it was a very difficult process for us to figure out where those problems lay. In fact, if you think about the unemployment that ensued in the wake of the 2008 financial crisis, it took something like 7 or 8 years for the employment levels to recover to their pre-2008 crisis levels. And my guess is that we're actually pretty close, if not already there, in seeing some of the jobs come back. And within another year or so, I suspect that we'll be well above the employment levels that we were in prior to the pandemic. And so I think the financial markets recognize that. And they take into account the combination of the pent-up demand that is part of the global economy. Things were going great, by the way, in 2019. Before the crisis ever hit, the growth around the world was going very strong. And our biggest worry was, is it really overheating, perhaps? That same kind of growth is still implicit in the global economy. but we need to deal with this public health crisis. Once we are behind the pandemic, I actually see some tremendously strong growth. And I think the stock markets around the world are simply just reflecting that reality. The combination of that pent-up demand coupled with the stimulus, and I hope that we are able to deal with the overstimulus, but the combination of those two things is why the stock market in 2020 in the United States was up about 17.5%. And year to date in 2021, we're up about 12%. I mean, that's really, really strong growth. But I think it's actually justified based upon those two situations that we're dealing with right now.
Thank you, Professor Low, and thank you for making the key distinction. This time around, the crisis was caused by a public health crisis, which has financial and economic implications. In 2008 and 2009 was really a housing crisis, which brought down the financial system and then brought down the economy. So every crisis is different. So maybe we'll turn over to Professor Scholes. What do you think of the current market, the investor psychology? Would you agree that people say the equity market today actually pricing perfection, right? Almost everything's going to be perfect going forward, or there's still more room actually to go. I know it's hard. We are not in the job or position to predict the market, but generally speaking, in terms of market psychology, right, and the cycle perspective.
I think Andrew's right, and others are right, that basically we are still in a growth period of time, and we're in a recovery cycle. And you've also seen in recent months the great increase in commodities and great increase in those and commodities, and also small companies and recovery type stocks in the marketplace. There's those who say, and I read Mr. Buffett's report yesterday, that he said one reason why the stock market is going up and so strong is because interest rates are very low. So therefore, the required rate of return on stocks is lower. I don't necessarily believe that, because one reason why interest rates are low is because maybe growth rates are not as great, and also we might have low expectations of earnings or earnings potential going forward. So, but basically, I think that with the combination of the redistribution model that I talked about, and the combination of whole new making things smaller as opposed to larger, we're giving a great opportunity to many small companies to really show their mettle and to really go forward in the economy. And so I think that there's many growth opportunities ahead. So what we're doing is going away from what is, as Professor Gordon said, we don't have any great themes, to think about that really will stimulate great increases in value for society. So now we're doing like 1,000 lights, or a lot of small opportunities that are really going to add growth in many dimensions in our society. And I think that's what tends to be supporting the stock market today. Plus, in addition, I think that with interest rates being so low, that in the marketplace, in some sense generated by quantitative easing and the Federal Reserve and other central bank policies around the world, that it's forcing investors to more into equities, and because, or into ways in which they're trying to think about hedging their risks, in the sense that if interest rates were before had a tremendous tailwind in the sense that they were going down and had very nice correlation properties with equities, going forward, it might be completely the obverse situation, where interest rates will more likely be going up with potential inflation or changes in central bank policy, which means that holding bonds is maybe more expensive in terms of the symmetry that you can get in being invested in equities.
Thank you, Professor Scholes. So speaking of the growth opportunities, what's the next question, probably the final question as well, what's your view on opportunities from ESG investing or sustainable investing? At the beginning, this was true the surprise for many people. At the beginning of the pandemic, some thought that the momentum of ESG investing will lose the momentum because we had to deal with the pandemic first. So the analogy I use, the pandemic is like a raging fire burning down the house, and the ESG challenge is more like a boiling frog syndrome. So naturally, we would focus on our attention and resources to put out the fire that's burning down the house first, and then turn around to take care of the frog in the boiling water, right? For the lack of a better analogy. But to many people's surprise, actually the ESG investment trend accelerated as well during the pandemic. I'm curious to what your view on these and what kind of a growth opportunity it presents to investors. So on that question, probably I would turn to Professor Scholes first.
As I said earlier, Ben, that I think that coal is dead. So basically, the world is going to have to try to figure out how to eliminate coal. And as we've seen in all the conferences around the world, from China to Europe, and that even China is moving away from coal. And as a result of moving away from coal, that means that we have huge substitution into areas such as solar. We have huge changes in hydrogen. Green hydrogen is a great growth area. And, the cost of that has to come down by something like 80%, before it becomes commercially available. Nuclear is a possibility moving forward. Other ways in which we have energy substitution is very important possibilities. So CO2 sequestration, as I said earlier, is another area. How we're going to think about the oceans and how our oceans are being destroyed with plastic and other things. And so as you move and increase the tax on these activities and have society change the rules, basically you'll have lots of new inventions and innovations to think about how to create energy, whether it's from electric vehicles, as we know, to other ways in which we can reduce the imprint of CO2 emissions, which I think is going to be a very important program from now till 2050, as we try to reduce the amount of CO2 that is in the atmosphere. So there's myriad investments that are going to be put into place because of the policy changes, and because corporation awareness, and because of all other awareness, which moves us away from reliance on our chemical infrastructure that we currently have, and our production of oil, coal, and high CO2, natural gas, high CO2 emitting technologies.
Thank you, Professor Scholes. Professor Lowe, what's your view in terms of growth opportunities from sustainable investing?
Well, I agree 100% with Myron about his observations regarding the changing of the guards in terms of the energy technology. But I think that this is actually a broader phenomenon. I think what we're seeing is a changing of the guards and a kind of a generational switch that is affecting a lot of different industries. In fact, the NYU finance professor Aswath Damodaran has a really interesting blog where he points out that if you look at the companies that have done well over the last 18 months and compare them to the companies that have done very poorly, you find out some interesting patterns. The companies that have done well tend to be the more high growth technology, younger companies, and the companies that have gotten hit hard are the more traditional, large cap, kind of older style, traditional companies. And in a way, that's kind of like a generational change where the younger generation is now their time to take over. And I have to say, not a moment too soon, because issues of climate change and pandemics and other kinds of social priorities are now at the forefront. And I believe that the younger generation is equipped to address many of these concerns. So we're going to see some tremendous shifts over the course of the next few years along these lines. And I think that there's some real potential breakthroughs that human civilization will make. But the one thing that I know will be a common denominator among all of those breakthroughs is they're all going to need finance. And they're going to need finance of some sort or another. So financial markets really play a critical role in facilitating that kind of changing of the guards.
So thank you, Professor Lowe. So you were saying that as a finance professor and investor, we don't have to worry about automation or technological disruptions. No matter what they do, they'll need finance. So that's good to know. And thank you for making the point of a generational shift. It is happening. Professor Marks, what's your view on the sustainable investing and opportunities that comes with it?
So I go back to my days in academia when I was a graduate student at the University of Chicago in the late 60s. And of course, Chicago was the bastion of free market economics and Milton Friedman, especially. And I was taught at Chicago that the only responsibility of the corporation is to make money for the shareholders, because it's a creation of the shareholders to own a company, and the profit that it makes is a measure of its contribution to societal welfare. Because what does a business do? It takes inputs, labor, raw materials, and capital. It produces a product. The difference between the selling price of the product and the cost of the inputs is the profit. So the more profit you make, the better a job you did, because you turned those resources into something more valuable for society. That's the thinking. And I think that the view of the corporation as having only the responsibility to make money reached its apogee under Presidents Clinton and Bush, both of whom were free market devotees, and so they kind of elevated it at that time. I think that especially during the pandemic, we've had a lot of time to think about issues like this. And they go into climate change, Black Lives Matter, all the things that are going on in society. And I think that the society is no longer willing to accept that the only job of the corporation is to make money. I think that society is now thinking about corporations like people. You know, they said, the Supreme Court said that corporations are people too. They can make political contributions. Their political speech cannot be interfered with. But I think that just like people, we now expect corporations to be good citizens. And that means not defiling the environment and giving people opportunities to work and succeed, and to use better governance and so forth. So society is insisting on social, not antisocial behavior. And that is pushing us in the direction of ESG. The clients are pushing for ESG. The money managers are responding with ESG. I don't think it's axiomatic that ESG investing will be more profitable, because if everybody decides to be an ESG investor and everybody rushes for the companies that score best under ESG, their prices will be bid up to the point where they will no longer be superior performers. And maybe the things like coal that people will turn away from will get so cheap that they'll be capable of better performance. Now, we may decide not to buy them because they're cheap, because they do produce antisocial outcomes. But you know, you have to understand investing to understand that ESG investing is not going to succeed return-wise because it's better for society necessarily, certainly not in the short run. And you know, but I think in the long term, we're not going to go back to you know, profits only. Now it gets challenging when the corporation has multiple masters, and you know, some progressives have proposed that corporations should recognize responsibilities other than to make money, but you know, like, it also has to work for the good of society. Well, how do you balance the two goals, and who says whether it's being done right, and could people then sue a corporation because even though it's making money, it's not great for society? Could they sue under generalized theory like that? You know, these are things we have to work through. But I think that ESG is certainly on a new higher level now, and the pandemic is part of the reason.
So I'm worried time is coming up. So we have time for the final remarks. If you have any final remarks to share with the audience, we will start with Professor Low first.
Well, I think the final remarks that I would have to say are that there's tremendous reason to be optimistic. We've been through a very difficult time. And the old quote by the philosopher Friedrich Nietzsche, whatever doesn't kill you, make you stronger, I think applies here. I think that we are going to come out of this stronger. We do have to worry about overstimulating the economy. But apart from that, I think there are many reasons for us to be optimistic about what is going to come over the course of the next 5 or 10 years.
Thank you. On the uplifting note, Professor Low. Professor Scholes, please.
I mean, I agree with others that basically the need for infrastructure is very important. Change in infrastructure is important. The need for redistribution is very important at this moment. And I also think the needs for innovation is very important and allowing us to handle many of the problems we have. Obviously, we can make mistakes, and the mistakes could be very costly. And so how we judge whether our programs are correct or when to be more aggressive or when to be less aggressive and what direction to take are just a warning that I have, because when we have individuals making decisions where they're putting their money on the line, then we have a different situation when the government is deciding how to spend money. And is the redistribution model that we're seeing combined with the infrastructure growth model and creating a new society, which is a different composition of how opportunities will move forward. We have to be very careful that we don't end up in a situation where we have atrophy and basically we think we're moving correctly, but we're moving entirely incorrectly. So I don't know how to judge that at this moment, but that's what my warning is.
Thank you, Professor Scholes. I guess one thing we can do in that kind of situation is be agile, be adaptive, and be very alert in terms of the impact of our policy. Yeah, on that note, the final remarks by Professor Marks.
The greatest opportunity lies in the things that have not been rewarded yet. The market bifurcated considerably when it rebounded starting last March. The things that were untroubled or that had benefited from the pandemic did great. Technology stocks boomed. The things that were negatively affected by the pandemic and where we saw challenges in their return really suffered and lagged. So I think that things that are iffy and complex and so forth have lagged. So that means to me that the opportunity lies in finding any that have been punished unduly. We're talking about companies where they have pandemic-related problems, where they have some challenges, but where the securities have been demoted too much or have lagged the market recovery too much. We're talking about certain aspects of real estate, like retail, real estate, and hospitality, and maybe big city office. And we're talking about companies that have products, as I said before, that rely on getting people together. And because that's still problematic, the securities languished. That's where you find bargains. You find bargains in the things that people underrate. Sometimes you find bargains in things that are great things, but sometimes in things that are less than great, but are underrated.
Okay, thank you, Professor Marks, and thank you, everyone. Professor Low, Professor Scholes, and Professor Marks, it has been truly a great honor to have you with us today to share with us your insights on the economy and the financial markets. I know it's a virtual conference. We cannot really give you a round of applause, but we really appreciate your time and effort and support to our community. Thank you.